Hello, everybody. Welcome back to the Flow Show. I'm Sean McLaughlin. He's Steve Straza. It's Monday. It's my favorite day of the week. What's happening, Straza? How was your little vacation?
Little hiatus, right?
You
It was
you
great.
are you're like me. You're terrible at taking vacations. You were in Slack all week. You were sending
Mhm.
me ideas. We were chatting. Terrible vacation.
Somebody on the internet on the Twitter was like, "Dude, what are you doing? Like, you're working?" Because I was tweeting charts and stuff. We're very lucky because it doesn't matter what my job is or what I'm doing or where I am. I'm gonna wake up, look at charts, look at my accounts, like look at my watch list. It's just programmed to do it. I think we're very lucky that we're so passionate about our jobs. That's why it seems like we can't take a vacation because we're doing what we like. I don't know.
I don't know. It goes back to like my early days in trading. I was on vacation in Mardi Gras in the year 2000, which was the precise moment that the Nasdaq peaked. The dot-com bubble peaked during the week I was at Mardi Gras, and I was getting phone calls from the guys back at the office telling me, "You got to get back here. We're all killing it. We're making so much money.
Yep.
Everybody was making so much money." And I feel like I missed out on a generational opportunity to make some money, and it's like stuck with me ever since. I've like never wanted to take a vacation ever since.
I don't know if it's psychological or if it's the market just messing with us, but we've talked about this before. For better or worse, for upside volatility or downside volatility, whenever I'm away or we're traveling for a conference or we're traveling for some of the things that we do, the market seems to be moving in a way where we're like, shit, God damn it. You know what I mean? But maybe that's just us. And we think that no matter what. I don't know. I don't know. Is there something there?
Yeah, no, there's something there. Our friend Barry Ritholtz likes to say whenever he travels, the market tends to correct pretty severely every time he travels.
I think it just feels that way for a lot of people. We're just too plugged in. Like we always have to be there for the action. Any little thing happens, get a little
Yeah.
sell off one day. We're out at a conference, like God, shit.
All right. So, for those of you first time in here, this is the Flow Show, and what we do is me and Straza. This is something me and Straza do every day, but one day a week we broadcast this live for you. We kind of go through the process of how we put together options trades. I lean on Straza as the technical analyst expert. He serves up some ideas that are top of mind for him that he likes as an equities trader. And I look at them and say, "Ooh, maybe I like this as an options trade, maybe I don't." And we figure out ways to trade them with options if we like them. How'd I do that? Did I explain it well, what we're trying to do here?
I think it's perfect. We are always looking for the best trade. Every morning we wake up and we're looking for what's the best trade on the books today. And we talk about it. We have this beautiful big analyst team. We got Sean, we got JC. So we're constantly chatting about ideas. And when Sean and we do this so much, we figured why not just make it a live show? And I think people really enjoy it. So we just try to get on here on air and kind of work through it, in real time. I cheated a little bit today. I made a deck for Sean. I sent him the slide deck. You looked at it?
I looked at it, and there was one chart that caught my eye.
Only one, huh? Only one? You hated the rest.
I didn't hate anything, but there was one that when I immediately looked at it, I said, "Ooh." And so I like it when I have that reaction. That's usually a good sign.
Before you tell me what it is, let's give people some context. Energy. You notice the theme? They're all energy charts. I even deleted out the coal. I want it to be just oil and gas. I woke up this morning and I felt the feeling kind of creeping in last week, at the end of last week. I woke up this morning and I asked myself, do I own enough oil and gas stocks? Like, do I literally own enough energy? I'm not sure. Earlier this year, and I think I've been obnoxious enough about it, and I still feel this way. I was asking myself, do I have enough financial exposure? Do I own enough of these banks? Right before we got on, buying more banks today. But we've done this. We've talked about the banks plenty, I feel like, over the past month or two. I think it's time to talk about energy.
Yeah. Especially after you showed me some of those charts, I think I'm with you, buddy. And I definitely don't own enough energy. I don't think I own any energy.
So here's the
Oh,
back.
I do own one, next gen, but it's a trade that's not working.
And it's uranium. Like I'm specifically talking about, we're in the uranium, we're in the coal. We've been in both of those groups. It's the oil and gas that it seems to me nobody's paying attention. Everybody's kind of like turned their back on the space. Oil and gas, that great 2020, great 21. Now it's over. People are forgetting about it. That tends to be the most opportune time, right, to revisit this kind of stuff. And when you zoom out, for me, Izzy, throwing up the chart now, structurally, this is just a huge development. Energy is working on a 15, 16-year base that takes us all the way back to prior to the great financial crisis, showing XLE here, zoomed all the way out in a weekly chart. And just look at the past few years, right? This was one of the, most wild advances this sector has seen off of the 2020 lows, straight line higher, up 4x in less than a year, and then straight sideways. In different energy charts will look slightly different, but the point here is we had, a huge rally phase, huge up leg, right into a very logical overhead supply zone, right? So dealing with this resistance, and now straight sideways since, I don't know, summer of 2022. So going on 2 years now of just digesting those gains off the COVID lows. When these things finally resolve these ranges, we're going to err in the direction that they're going to resolve them higher, right? Along with the underlying trend, which is higher. There's going to be some huge trades here. I think we should be ready for it. So would you like for the day?
I always do a double take when you say I'm like, what did he say? Oh,
ERR. We're going to err in the direction of the trend.
Sorry, that's just me. No, I love it. Looking at that XLE chart that you're showing right now, one thing that comes to mind as an options trader is I'm seeing a consolidation near all-time highs. We're seeing a tightening consolidation. So that makes me think that, there might be some good cheap premium here because people are just getting bored in this sector. Yeah. There's no real fear because we're up at near all-time highs. So I'm just putting that back in my mind when we start looking at some ideas.
There's a lesson there. Sean, does a trendless market lend itself to lower implied volatility as a general?
Generally, yes. Not always. Yeah. But think about it. If a stock or an index has been going sideways for a long time, anyone who is aggressively bullish or aggressively bearish, they're just getting ground down, right? They're like the move they're waiting for hasn't been happening. So they're getting tired out, they're exiting their positions, and they're just like, okay, well, I guess the move isn't happening, and there's no real demand to either protect themselves if they're worried about a sell-off or, buy options to anticipate a big move because you've been watching this thing go sideways forever. It's like, oh, well, I could probably wait another week. There's no hurry here. No urgency.
Implied vol, hitting depressed levels or really contracting, more or less speaks to people quitting on making directional bets in the options. Is that right? At the end of the day, that's what it is. A market that's trending like in a vertical line higher, you got people coming, making aggressive directional bets to the upside. The bears coming out, trying to fade it, making aggressive directional bets to the downside. If you're stuck sideways in a range for 2 years, what you're saying is market participants say, forget it. We'll go find something that's trending.
Yeah, sideways markets, they don't stop you out. They wear you out, right? And you just get bored and you look for other things or whatever, but there's no urgency to be protecting yourself or taking aggressive bets because, it's like, okay, I'll just wait for the market to show me, right? And then they'll take action.
All right. So what's the move here? What do you think?
Well, I looked through the charts that you shared. And again, none of them I hated, but one that stood out to me was the Valero, VLO. That's the one. That's the one I like. You're smiling. Were you thinking were you guessing that's the one I was going to pick?
I thought you would either say to me leaps on the IMO or the Valero. The Valero looks so good, and this is an industry leader, right? It's really a bellwether in terms of as a refiner, them and Marathon. And the charts tend to look very similar when we zoom out over time. Let's look at what MPC, I believe it is, Marathon Petroleum, has done. All we really need to do here is make the bet that Valero is going to end up looking like Marathon. So Marathon already took out those 2018 highs back in 2022 and just keeps cruising.
Valero, wow, it's a double since 2022.
Yeah. Valero, literally the closest competitor you could find to Marathon, just now getting above those 2022 highs, a far less vertical looking situation here, right, than the one we just showed in MPC. Like you said, we got some good sideways here, straight up off the 2020 lows, and now sideways for just about 2 years. Boy, if this thing goes, if and when it goes, I think you want to be aggressively long. And from an actionability standpoint, this one really stands out because we're right there.
Yeah, and so two things I like, additional things that I like is that number one, the trading action today is confirming our thoughts that this thing looks like it's ready to break out. We're having a nice
Yeah.
big green candle today.
And energy's not doing great today. So that really stands out.
Yeah. And secondly, and this is not surprising because I mentioned it earlier, looking at an XLE chart, implied volatility very low, not the lowest, but certainly very low, very favorable for buying calls here. And so I don't know if I would do a leap necessarily. I'm open to it, but like let's for example, let's look at well, January 2025 calls. So that's 10 months from now. That's on the edge of a leap. Ooh, the 200 strike, which is, what is that? 25% away from here? No,
Like
33%.
Yeah.
The 200 strike calls expiring in January would cost us about 6.25. I don't know. That feels aggressive. I don't know.
If this was an E&P name, I would say, yeah, easily 33% in a year. And this probably gets that done on a resolution here, but it feels expensive.
Yeah, it does feel expensive. I would rather maybe go a little closer in time, go into September, get the whole summer driving season under our belt, right?
Yeah.
And the 175 calls in September, we can get for about less than 450.
I like that.
That feels a little bit more accessible.
And this base is like, this thing is ready. It's going to go soon. I don't think we need 10 months.
Right.
Yeah, I like that. So 175, we're talking about, Sean, less than 20%. Easy.
Yeah. The 175 strike, that currently has a approximately 25 delta strike, which is, we talk about this a lot, but whenever I'm buying calls, I generally prefer buying the 25 delta options because they're relatively affordable. So my risk is limited, but I'll get a lot of good leverage if it goes my way, if this thing really takes off. So if this thing makes a run to 175 over the next couple of months, there's, really good chance that these options will double, maybe triple. And if it exceeds 175, then we're really cooking.
Yep. Let's do it. I'm on board with this one. I'll put this on. I like this.
All right. VLO, September, writing this down, September 175 calls. Looks like we can get in about, under 450, maybe 425 if we're lucky, if we're patient.
And another thing that we're doing here, using Valero as a vehicle, I think this is a good conversation for us to have. We're done with the options part. Izzy, if you want to flip back to my screen. Energy has been not weak, right? Because they're not breaking down, but also not participating in the way everything else has been participating in the current bull market. If there's one space that really stands out, continues to stand out from a leadership perspective, because we have a lot of nice like subgroups, right? So we have all the data for what the different groups within energy are doing. Typically, these cycles are kicked off by the explorers and producers, and then eventually the oil services join the party. Since we've been sideways for the past like year and a half, 2 years now, it's been the midstream operators, the MLPs, and a lot of times those aren't great for trading. They pay like 15% yields. They're slow movers. And the refiners, right? So this is the refining ETF, crack. Look at the absolute price chart of refiners as a subgroup. Nothing else in the oil and gas space looks this good. These things have gone straight sideways since September 2018. Wow. We're going on like 6 years of sideways now, just building this base. When this thing goes and takes out these 2022 and last year's highs, call it like 36 and crack, this is where you want to be. And this is the space right now. Does that change if we enter like a new leg up, right? Or a new like rally phase for energy? Do the more risk on groups take that leadership back? Maybe, probably. But for now, these are the ones to be in.
Yeah. Hey, let's go back to that VLO chart for a second because we have some comments coming in the comment section. Michael H is wondering, are we at any risk of a double top in VLO?
No.
I mean, okay, you say no. And I will say, yeah, anything could happen, Michael. But if we put a trade on where we've defined our risk and we're wrong, then, That's the cost of doing business. I think I'm looking at a zoomed in daily chart on my screen, and if I were to put a VLO trade on here, I would probably use last week's low as my stop. So maybe that's a little bit aggressive, but maybe 138 would be a good stop level. As long as we stay above 138, we're good.
Yeah.
But yeah, I mean, look, anything could happen. Maybe a triple top forms. Doesn't matter, right? We can't predict the future, but if this thing breaks out and we're positioned properly, our potential reward far exceeds our max risk.
So, most people know just enough about technical analysis to hurt themselves because the way that they teach, like the high level, principles of technical analysis, it's stuff like use RSI or momentum indicators as a mean reverting strategy. Pay way too much attention to the patterns and the specifics of the patterns rather than the actual essence of the patterns. There's a joke in the technical community that there's no such thing as a triple top. Why do technicians say that there's no such thing as a triple top? Because when you look at something like this, right, this would be going for a quadruple top in the case of Valero since May of 2022, right? It's not that they don't exist. It's that they're very, very rare because the essence of this pattern, the fact that bulls or buyers are aggressive enough to keep running it back to this level and hitting this level and absorbing more and more overhead supply as they continue to do that is wildly bullish, especially in a sideways trendless market. The fact that they just keep hitting this level. Eventually, all that overhead supply is absorbed and you break through. The other thing that makes double tops, more sexy than practical is that for a double top to confirm, according to the textbook, you need to violate the low in between the two tops. So by the time you know that this pattern is the pattern that you're thinking maybe it is, we have gone from 145 all the way down to 120, right? So that's a huge hit. So what are you going to do in the meantime? Or if you're talking about the triple top, we would have to violate this 100 level, so fall by 50%. Or in the case of the quadruple top, if you want confirmation for that, it's all the way down at 96.50. So what do you really do with that, right? Maybe it's a double top. By the time you know it's fallen 50%, it's just not helpful information. What this looks like to me is a really, really strong rally off the 2020 lows, and then 2 years of very well-deserved and constructive consolidation.
Well, hey, great way to walk through that, Straza. Very good. I hope people got something from that. And I will just add that, yeah, we could sit there and wait for that double or triple top to confirm. We won't. We'll get out far before that. But I look at a chart like this, and instead of thinking to myself, oh my goodness, I'm worried about a double or triple top, I'm looking at the fact that there's nothing but blue skies up ahead. There is no resistance. There are no bag holders. These are all-time highs. If we get up to 175, there's no reason to sell that stock unless you're just a wimp and you're afraid of gains, right? And we've talked about this all the time. I love stocks making new all-time highs or getting close to new all-time highs because that is a potential incredible opportunity. And I want to address one more comment that came in the chat there about VLO. I think it was Brian. Brian mentioned as a trade idea for VLO, instead of doing long calls like we're talking about, maybe doing a call calendar spread. And I don't hate that idea, Brian. For those of you who don't know what a call calendar spread is, you would let's say stock's trading 145-ish right now. Let's just ballpark. Yeah. You would maybe buy out of the money, an out of the money call calendar spread. So let's say the 150 strike. What you would do is you would sell. This sounds counterintuitive if you're bullish, but you would sell a call option in, let's say, April. I'm just making this up, but you sell an April 150 call, but then you buy a later expiration, maybe a September 150 call. And what that does is that lowers your cost of buying that September call. The risk is the position moves too fast. If the stock actually takes off and blows up past your strike price before those short calls expire, then you get on the backside of the P&L curve, which is not where you want to be. So your potential gains are limited until those April call options expire. But Brian, I will point out that with volatility low in VLO options right now, meaning options are generally cheap, putting on a calendar spread of any kind is an edge trade, meaning if Volatility is unlikely to fall much further from here, but in the case of volatility rises, that will actually aid the value of the calendar spread because it's a long volatility trade. Now, in my opinion, I think that long volatility calendar spreads work better if you're doing it with puts and you're doing it below the market, because when the market sells off, you're definitely going to get volatility rising and the trade's coming into your strikes, which means it's going in the direction you want it to. But I don't hate the call calendar spread, but I think it's a little bit more conservative than what I'm looking for in this trade with a stock about to make all-time highs. I don't want to cap my gains or risk capping my gains.
I like what you're saying there. I feel the same way, but this is the right pattern for the call calendar. This strategy has really grown on me because what it allows you to do is get in maybe early and anticipate a breakout, but still be okay if it takes a while for that breakout to materialize. We look at this kind of pattern in these energy stocks for a year now saying, they're probably going to go, but when are they going to go, right? And the call calendar helps with that. If you get more sideways, it's okay. If this thing takes 3 months and we're still looking at it in June and we got September calls, it finally breaks out, then you cover the short side, right? Or you cover what you sold, yeah. And then you just have the long calls. I like that. I think there's a lot of time and places for this strategy.
Yeah. I generally prefer the call calendar spread when we've got, like, I'm bullish on the stock, right? But we've got an upside level where it could act as resistance, right? Like maybe we're 10% below the highs or 15% below the highs. Right. And we may get up to those highs and that may just put a pause in things for a little bit because we got some bag holders who want to get out back to even. That's where I think a call calendar spread works really well, but that's not the case here.
This one's too close to breaking out.
Yeah, right? Too close.
It's right there at the upper bounds. Yeah. So what Sean's saying is maybe if we're back here by the pivot lows, like, right in the dead center of this range, then maybe it makes more sense. We're right here. Like by the time we get off this video, this one could be making a decisive upside resolution. Then you would say to yourself, shit, I wish I didn't sell the calls.
Exactly. And I could bring a real world example where I regretted putting on a call calendar spread just recently. Straza, you and I think you were in on this trade with me. We bought a call calendar spread in the healthcare sector ETF XLV a few weeks ago. And boy, the sector took off and it went up to our short strike and we had to exit the trade. We made money on it, but I mean, far less money than we were hoping to make. It's a first class problem, right? Our profits just aren't big enough, but it's a problem nonetheless.
Energy, this thing, I mean, healthcare, this thing goes sideways for 2 years. As soon as we put on a sideways trade, it friggin' breaks out. Love it.
All right, Strategy, let's bring it home here. We like the energy sector. There's a lot of names that are showing up on our radar. Yeah. Me personally, as the options trader in the house, I like this VLO trade. I like it because we're at or near all-time highs. Volatility is cheap. We can position with calls. It's a simple trade. I know that people are attracted to options because they like putting on these fancy multi-legged spreads that have all kinds of moving parts, and that's exciting to people. Yeah. Cool. If that's you, great. Do that. Me, I like to keep it as simple as possible because I got a lot of different positions on. I don't want to be micromanaging 50 positions. I like to keep things simple. And whenever I can position with a simple long call trade on a stock making all-time highs or about to make all-time highs, I'll do those trades all day long.
Low volatility. The pattern dictates that we should want as much upside risk as possible. Long calls. That's it.
All right, that's our trade this week. VLO, September, 175 calls, 450 or better or cheaper if you can get them. That's what we're doing. Good work today, Straz. I'm feeling good about this one.
Listen, this was fun. I'm good energy today, right? I had the whole week off. Back to video. I'm ready to go, baby. This is fun.
Hey, we're glad to have you back. The show is too one-sided, letting JC win all his arguments against himself on the morning show. Just not cool.
He needs me there. He needs me there to balance him out,
You're the good balance. You're the yin to his yang. It's good.
We have fun. Yeah.
All right, everybody. This has been the Flow Show. We'll be back next week, same time, same channel. Until then, trade them well. We'll see you on the morning show in the mornings. Take care, everybody.
Later.